Welcome to the Live Squawk podcast, where professional traders, investors and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Good morning, good afternoon, good evening. So thank you for joining anyway. I appreciate that. And just in terms of introductions for everyone. So just for anyone who are new to this, this is our stream and a preview show, Live Squawk's preview show ahead of today's US non-farm payroll report. I'm joined by long-time market professional Beat Nussbaumer, founder and CEO of MacroBeat, FX trader, FX macro trader, research and FX tutor. He's been a market professional for probably, he says nearly 40 years. It must be 40 years now, surely. Is it 40 years yet, or is he still nearly?
It's past 40 years, I admit.
Don't worry, I'm past 30 years. Well, am I past 30 years? Yes, I am. I'm well past 30 years, 33 years in the markets from a mere babe. Anyway, this is, so Beat's my guest for today, and we're here to discuss really the ins and outs of today's US jobs report, potentially the biggest jobs report of the year. So potentially the biggest figure at the US this year, with so much riding on it. Just to give you an outline of what we're expecting in terms of the number itself. So for the headline number, and there are graphics I'll put up as well on this, we'll go through the ranges. But change in non-farm payrolls for August, seen at 165,000 after last month's, I say anemic, it's still not bad, 114,000. But there was outside factors, as we'll read from some of the analysts' research papers, as to why we saw such a low number and why we're looking for such a rebound this month. Change in private payroll seen at 140,000. That would be a rise from 97,000 last time out. Manufacturing payrolls expected to fall by 2,000 after gaining by 1,000. The unemployment rate set to drop a tenth to 4.2% this month, for the month of August. Average hourly earnings, often a feature of the jobs report this year, expected to rise a tenth to 0.3% versus 0.2%. Annually, we're looking for a 3.7% mark from 3.6%. Average weekly hours, all employees seen at 34.3 from 34.2. Labour force participation expected at 62.7. That would leave it unchanged. And the underemployment rate last time out came in at 7.8%. We have a preview up on the board for those members of Live Squawk. If you're not a member, don't worry. It's up on Twitter for those who want to have a read of that as well. And we can get into the weeds a little bit more now about what to expect. So I want to give you just an outline of what some of the banks are saying here. I'll give you Barclays' preview on it. They say they expect non-farm payroll employment to have risen by 175,000. Again, that's up 10,000 from the current consensus in August, alongside a decline in the unemployment rate to 4.2%. They say we also forecast a rebound in August, alongside a rebound in the work week to 34.3 hours, and an acceleration in average hourly earnings to 0.3%, boosting incomes. Again, we've had, they also mentioned the JOLTS survey, and that got a bit of reaction, and we'll go over some of the reaction to that. City analysts are at the other end of the scale. They're looking for 120,000 increase, and they say this would be a solid pace of job growth, but some of the continued strength likely reflects measurement issues that are known to have skewed monthly jobs figures substantially higher in the year ending in March. These measurements issues that could continue to result in too strong job growth mean that even 125,000 jobs added in August could be mentally discounted by market and Fed officials alike. We'll get into that as well in terms of what they mean by that, and we'll also discuss the markets and dynamics around what to expect. So so at this point, I will introduce Beat to the broadcast, and welcome, Beat. And just your view of what you think today's number. I mean, listen, you haven't got the resources that some of these banks have. But basically, what do you think about today's number? Where are you at with today's number? And as a trader, what are you focused on?
Yeah, thanks very much for having me today again. It's a pleasure to be here. To be honest, I think you alluded to it already, how complicated today is going to be. And I think I want to start with a few of the things to look at. One, I think we have to understand where the market is. The market is, once you sell dollars, the market wants to bully the Fed into a 50 basis points cut. That is just a given. We saw this with a reaction on, how quickly we sell off on tier 2 data like JOLTS or ADP, and then a brief bounce on the stronger ISM. But the market is just so focused on that rate cuts or the 100 basis points for the rest of the year that that is what the market wants to do. And this is just always important to know as a trader also. The second thing I would want to say before we go into a little bit more details, I think the way I look at it is a strong number is just a micro event and a weak number is a macro event. That's the way I look at it. A short term, let's say if we get 200K, like Bank of America is looking for, or anything north of 180K, we probably, this is what I'm playing, I have a few sneaky small dollar longs, bought some dollar in the dip this morning, just from a pure asymmetric risk point of view. The market been selling a lot of dollars. We're looking at European data, and got to say again this morning, IP data out of Germany and France just look horrific. I made a joke this morning, maybe we should be looking at the ECB should cut 50 rather than the Fed, but that's a different story. One thing is the market is so unsure about everything. Remember we had this summer meltdown, we had all these sort of nerves, we have this BOJ story on the other side, we have the whole suddenly carry online 2.0 that we've seen in the last few days. So much playing into it that I think this is far more complicated than meets the eye. I would also suggest that we have to look at different dollars in a different way. The clear dollar down, as in for a weak number, is and continues to be dollar yen. Why? We have a BOJ that's going to hike rates, whether it's September or December, who cares? We had the ex-BOJ member today again talk about that the market may underestimate how much a BOJ is going to hike. So we have that whole carry-on ride story is here to stay. So dollar yen, yeah, even if we get a strong number, we may bounce 200 points. We have a few days of, whatever, smoke and mirror before those sort of stronger yen trends may resume. On the other side, we have euro, dollar, cable, some of these other pairs, which if you already look now, the dollar sell-off has really kind of been very muted. Also after ADP and after the JOLTS. Yeah, we had a quick rally in the euro, but reality is, do you really want to buy euro dollar up here aggressively? Because we have a cut, we have a cycle from the ECB, we have a cycle from other central banks that cut rates. So this is foreign exchange, which means what? We actually look at two currencies at the same time. And so we have the ECB cut, the Fed cut. Okay, we can now have a toss-up on who is going to cut more the rest of 2024, who is going to cut more in 2025. And yes, that's why sterling was a bit of an outperformer in the short term, because we feel the Bank of England is the one that cuts the least, at least until year end anyway. But I don't want to go into all my bearish view on sterling for all the political reasons. We leave that for another day. So personally, I think that today is really about, for me personally, as I said, I'm sneaky long some dollars into it from an asymmetric risk point of view, because the dollar sold off a lot and people look for a weak one. But I'm very quickly to flip in the first few seconds. If it's going to be a weak one, around 100K or just below 100K, I might cut my dollar longs and just lean back, wait and see. I'm not going to sell dollars. If we were to get something like 50K or lower, I would also flip, not only flip from long dollars, I would also immediately flip to short dollars on a 50K or less. 120K to 180K, I actually won't touch anything. So 180K may see a little bit of a dollar bounce, 120K may see a little bit of a dollar dip. Now, sorry if I carry on, I just have one or two things to say. Like we said, the Fed, we know the Fed wants to cut. Personally, I think they're going to cut. Why? Because they probably hiked too much. So yes, they may cut rates earlier than in previous cycles. Every cycle previous this one, if I'm not mistaken, they cut rates when unemployment hit 5.7%. We had 4.3. So that's not meaning that they're going to wait to 5.7 this time because it's a bit too political. So yes, they can also cut when if it's 4.3, but I'm not sure they really want to cut 50 because 50 also signals to the market what? That they're behind the curve, you know? Look at the other data, they're not that weak. Yeah, they're weakening, but they're not weak. So I think the market is still hunting a bit too much here with the 100 basis points price for the rest of the year, or even slightly above 100 basis points. We saw how quickly the market panicked in the summer meltdown. Some people started to talk about intermittent cuts, which really had me laugh because that's a typical kind of reaction from the equity guys. As soon as something goes wrong, they start crying.
That was lunacy, to be fair.
That's yet another story altogether. So personally, I just feel, and this is where the difficulty is. The Fed wants to cut. We understand that. Does it really matter if it's going to be 25 or 50 at the end of the day? Maybe they cut 50 and then pause in November and cut in December. I think we get 75 basis points the rest of the year. And yes, of course, this is the Fed, but we are here today. We talk about today's number. And so today is very clear. The weak number, the market goes for 50, rightly or wrongly. If it's a somewhat strong one or okay one, then I think we settle for 25. We have two Fed speakers today, Waller and Williams. I don't think they matter unless the Fed would want to cut 50 and the number would be good. Today's the last chance they could sort of give a hint because the blackout period starts tomorrow. So it's a very complicated thing. To the end, before I just hand back to you, Harry, as I said before, we have to start to separate the dollars. There are different dollars that will do different things. If we get a very weak one, right? I mean, proper weak as in, 70K.
Below last month.
Yeah. Then we have also risk off to consider. We are back in the situation where we're going to have small weak is good for stocks. A very weak is bad for stocks. So that means what? Also, we have to look at currencies like Aussie dollar. If you have a small weak, yeah, we can buy Aussie dollar. It's great, right? Because the RBA is still more on the hawkish side. So selling dollars against the Aussie makes sense. If it's very weak, stock's gonna crater, so you don't want to buy Aussie. So all avenues feel to lead back to dollar yen and dollar Swiss, possibly that on a weak one or on a proper weak one, you just close your eyes and sell dollar yen and dollar Swiss as probably the easiest dollars to sell. I think the euro dollar is the most boring dollar to sell, as in buy euro. People will have a go at cable because, as we said, unclear about the Bank of England may not cut that much. So that is what I said. I think everyone that is trading the event has to probably select a pair where they go, okay, that is where either my view is covered or where I see the strongest reaction. I think to talk about dollar up or dollar down is the wrong conversation.
Understood. Just, I want to break down, taking some notes on what you said. It's interesting, you've mentioned like you factored in 75 basis points worth of rate reductions this year, this side of Christmas. And again, there's a Citi note doing the rounds at the moment that agrees with you basically. Citi traders wager on 3.5 point Fed, 3.5 point, actually I read that wrong, wager on 3.5 point Fed rate cuts this year. Trading desk's view is more aggressive than the bank's economists. Swaps currently imply around 100 basis points of Fed easing this year. So, I mean, that's very aggressive, and it would suggest that not only are the Fed behind.
To be honest, if 3 times 50 were to be true, which I think is absolutely ludicrous from a data point of view, but if we were to get it, then I have to slowly become one of these conspiracy theorists and would have to say Powell got a little phone call from either Yellen or the White House that just demands rate cuts so they can afford the bloody debts, right? So this is the other thing that is really far away in my head that says, okay, why is the Fed so early in the cycle to cut? Because we always know they're going to be behind the curve. The inflation shock was so big and they were so criticized for being late, blah, blah, blah. We always knew that they're going to be late to cut because they're only going to cut until the last person realizes they can cut. Yeah. So now, where's the U.S. economy really in comparison to the rest of the world, or let's say Europe and some of the others? I think they're not that weak, aren't they? They're softening, but they're not weak. So I struggle here. This brings me back to something we discussed after Jackson Hole. If we flick back, and this is still my biggest annoyance of the last 2 months, if we flick back to the press conference from the July Fed meeting,
Right.
Powell did not hint in any sort of way that they're going to cut rates in September. Then suddenly the minutes read, some wanted to have a July cut, and the majority wants a September cut. That was nowhere in the press conference in July. So I'm not quite sure where those minutes came from. And again, I don't want to say they were kind of fabricated in a bit like the job revisions were. I don't know. But it just is very odd to have such a shift from the July press conference to the Jackson Hole speech, with actually not a lot of data points happened in the meantime. Is the job market cooling down? Yes. I could even come with another story, and this is not a conspiracy or I read it somewhere or whatever story. This is real. Last year, we could officially read that firms, at least 2 out of 5, did admit that they put out job ads without actually wanting to hire people, just staff. That they, sorry, you're overworked. Yeah, we're looking for people. So now we talked about jobs. That's why I had to laugh about the reaction of jobs this week. There are some of these data points, in my opinion, are very weak data points. So, but again, that's a different story. We have to deal with what we see. So personally, what you just said, 3 times 50, sounds absolutely ludicrous. Because then we really panic. Because then we really have to think they know something.
Okay, well, let's counter this. Rates don't need to be at 5.25%, 5.5%.
Correct.
You know, where the inflation level sits right now doesn't warrant this level of tightness in with the market. So again, I haven't done the calculations, but from what I've read, I think you've got to start looking towards the 3% mark, because it's more, I think, more appropriate for even that. I'd say maybe an issue. But so they are, we take it for granted, they are behind the curve. If they want to get ahead of things at the moment, and again, you've mentioned data, but I'll argue the case that it's retrospective. And
correct.
If they have an economy that's slowing down, or they have forward-looking indicators that say the economy is slowing down faster now than it was a month ago, 2 months ago, they may warrant or will think it warrants going 50 basis points. So that's just to counter that. But I'm arguing against myself now, because you look at the September, look at global services PMI, for example, at the US. Yeah. Business activity, this is from the release, rose at its fastest pace since March 2022. That doesn't sound like an economy about to hit a hard landing.
To be honest, it could still be that the sort of other version, which I sort of came around to that one probably yesterday or so, when I thought, well, okay, maybe we do 50, then we pause in November, then we do 25. What I do not believe is they do 25 and then do 50 in November, or and catching up later to make it 100 basis points for the rest of 2024. So either they go 50, then they go, pause in November. I still think this whole election, I know that they have to do policy whenever it's appropriate, but let's also not forget they haven't really, I can't remember in many election cycles. I would have to go really back. I don't hold me to that, but most recent, the Fed really stayed well clear of the election, which can be a coincidence because there was never a need to. I remember there were cycles where there could have been a need to, but they stayed clear at least 3 months prior to the election, sometimes even 6 months prior to the election. So I think the September cut would already be a little bit of a Trump may have a word to say about that one, and then go again in November. I think the meeting in November is past the election, I think, isn't it? November 7 is the November meeting, so that's just after the election, I think, right?
Yes, I can confirm that, but we'll get the details.
Yeah. So to be honest, like I said, I agree with you on something completely. We discussed this during the year, where I've been the inflation bear and the rates bear. The only reason why I say what I say is because it felt all year the fixed income market has got ahead of itself on both sides. going for 170 basis points early in the year, then we nearly went for rate hikes, and then we went for the higher for longer, and now we suddenly go again for aggressive cuts. So we come full circle, it almost looks like, from early in the year. So I only stepped against these sort of, over exuberance of the fixed income market, which is just, seem on running around like a headless chicken. From as soon as we get a weak one, they go like all for cuts. We get a strong one, we go all for hikes. This is probably the first time where the market tries to settle with the story. And we get these moments in the cycle where the market just go like, you know what? This is the story, I'm gonna now go for it. And that's probably where we are right now. That's why even on a somewhat stronger number, we might not see the same rebound that we used to see, because that's why I call it a micro event. A stronger number to me is a short-term event, quickly a few, intraday punting, a few days punting, and then forget about it, while a weak number is a macro event. So I think that is really my core message today is, we're gonna have a few hours of fun if it's a strong one, even maybe a few days. But a weak one would be really trend-setting, I guess.
Yeah, I mean, the argument for a stronger number would be obviously Hurricane Beryl effects on last month's numbers, and the reversal of that gives more excuse if there is a strong number, and plays less into that whole narrative generally anyway, because it's just like, well, it's another anomaly. We'll have to wait until next month to see that smooth out a bit more. So I get reasoning on that front. But I do think on the other side, looking at the banks and this thirst in the markets for cuts this year has been with us since interest rates, since inflation was around 3%, 3 and a bit. They were calling this at the start of the year, the turn of the year. They were looking for a dovish Fed this year anyway, if I remember rightly. So I think there's always been that thirst there. I just want to read you a comment from this Citi report and their economist, and what he says. This is from Ashkai Singhal, Citi's global head of short-term interest rate trading. This Fed does not take baby steps. They showed no hesitation on the way up in 2022 and won't show any on the way down either. That was his comment. If today's jobs numbers disappoint, the Fed is likely to cut 50 basis points, not only in September, but in November and December too. Now, I agree on the first part. I do think that I didn't think we'd see 50 based on what we were talking about Jackson Hole and his and him being Powell's deference to trying to nail on a dovish turn. But I do think he's been one of the more dovish members of the FOMC, and there is a reason why there is that narrative out there. And I think any kind of excuse, and we said this yesterday when we were chatting, they can brush off a 50 basis point move in September and use a number of reasons for it, irrespective of what we get today, I guess. Yeah. And that's a big swing. And they can also make reasoning for a 25 basis point cut anyway. So I see this much more of a market event, and I also don't believe they pin all their last hopes on this jobs report. I know that Powell has discussed jobs over inflation now as their main gauge and their main trigger point, but they'd have looked at this in a cumulative fashion. And I think to base it on just today's number, especially with the weather effect that we had last time round, will be foolhardy. I don't see the Fed doing that. If they've been so careful up to this point and haven't cut yet, despite everyone's thinking that we are looking for. Or they are looking on the dovish side. I think people need to take this in as an event in itself. I
think you nailed the head on the head there. That's why in the beginning I mentioned this is an event today to just trade. Because it makes no difference. The Fed can cut 50. Let's just say, for us, it'd be easier to argue with the market when it's strong or when it's weak, or 25. But at the end of the day, as you rightly say, they could just go, you know what, we should have cut 25 in July and 25 in September, so let's do 50 in September. Then in November, we leave it open. We just call it, every meeting is live, and then we can pass or not pass. So at the end of the day, and that is where maybe the hype is a bit too big on the data today. It actually doesn't matter. The Fed has probably already sort of semi-decided where they're going for the next meeting. And as you rightly say, a weaker number is easier to explain. When it's a tad stronger, then they can still point to all the other things that come in a bit weaker. So this is about a few hours of fun out there, I think, which is the key. But what I stick to it, if we were to get 50K or a really weak one, then the market is really, then your report of 3 times 50 may suddenly, at least for a very short period of time, come into the frame where people go, oh, it's going to be more than 100 for the rest of the year. So I think it's more, like you say, a market event when a market either goes berserk and running ahead of itself again, rather than it actually changes anything on a policy level. I think the policy level is kind of, we know we get a cut, and whether 25 or 50 may not actually matter too much, unless it be 3 times 50, as this other report says, which I doubt, right? There's nothing out there that will make me think that.
Well, just on again, as I said, I listen. These are great markets to trade at the moment, because I do think there's a level of uncertainty during the rounds, and it's great because you're seeing volatility in jolts, which we've not had for years. For God's sake, let's be honest about it. I want to, before we sort of finish today, I want to look at the ramifications on the wider scale, on the global scale. I mean, first I want to say, if we were to get such a low number, I think the connotations for that and the ramifications rather for the markets would last into next week. Because I do think you then start to see equities start to look at itself really hard and just go, are we too high at the moment? It's, should we be repricing stuff? Because, if we're getting a number like that, a really low number on the labor market side of things, there could be unseen issues, and we don't like uncertainty. What I would say at the moment, I want to look at the wider picture. For example, I'd like to look at the ECB now briefly, and the Bank of England, and we saw Bank of Canada cut rates again by 25 basis points this week. He being Macklem, the governor, said that they weren't worried about the widening spread with the US, maybe because he knows something that we don't about where the Fed's going to be going in September. But is that the same concern you think the ECB would have? Should they be worried about the spread? Do you think this will, if we get 50 basis points maybe, or if we get weakening numbers and it looks like the market gears itself for 50 in the US, that the ECB will have to respond in kind, or do you think they need to act in the same veracity as the US?
That's a good question. To be honest, I don't think that they would do 50 if the Fed is doing 50, but they may do a very dovish 25 to make it very clear to the market that rates are going to come down maybe a bit faster than the market would have expected. So you have a way of communication, not that Lagarde is the best in communicating, but in some ways you have a way to communicate, because I think they stress too much this year that they're not the Fed, right?
Yeah.
Lagarde said it time and time again, we're not the Fed. So you can't then do 50 because the Fed does 50, when not so long ago some people in the ECB even didn't see a need to cut in September. I think given the recent data and given the news from the IFO out of Germany about no growing Germany and blah, 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 I guess that sort of thing is eaten, right? So I guess we definitely come back on 25. The CPI might also be a tiny bit sticky on one hand, but when you look at the German data of late, that came down rather hard. So I think everything is on green for the ECB to definitely cut faster than we would have thought possible a short moment ago. But I think it'd be to do 50.
Too reactionary.
Yes, I do think. But to be honest, we could get I don't want to say a hawkish 50 by the Fed, but a neutral 50 by the Fed and a dovish 25 by the ECB. That's why I did point earlier to the euro. In my view, it's definitely, it will trouble the ECB. I don't think they want to see a too weak dollar or a too strong euro, as it's just counterproductive at the very moment. They're not doing soft euro policy, not at all, but I think there would be trouble, not at 111 or 112, but if the euro would suddenly start to approach 115, I think they would have a real problem. But they could get away with that by, like I said, a very dovish 25 cut and really make the market reprice the number of cuts we're going to get in the near term. But they're not going to go 50, I think.
No, we're good, thank you. And then just quickly on the Bank of England, as you know, they're coming up in September as well. Look, we've got a new government in. They're redoing there's a fiscal black hole that they're trying to, what they say they have to plug, and it's going to mean some level of some tax rises and cutbacks. Are they the new Tories in that sense? And where does it leave the Bank of England itself in terms of its policy goals? Will they sit back and just see what the government does, or do you think they'll try and get ahead of what they see as an austere budget coming?
That's, to be honest, you're asking obviously all the very good questions here.
Yeah.
The problem is we have the wage problem on the one side, right, where the Labour Party, the first thing they came into power, just start to pay their mates at the unions. So that's a bit of a problem. It's funny to see that the wage data without bonus was actually higher than the one with bonus for some reason. I guess we know why. So the Bank of England has this kind of problem that the wage side of things are still looking a bit sticky. But personally, you know my opinion, I'm getting very bearish on sterling, on the UK. I think we're gonna mess things up with whatever policy is incoming. I think so if you hear some noise, that's just a terrible rain that just started here. I think I really think some of the things I've seen out there right now on the policy front, it just makes me nervous that people truly think that the UK is open for business. I'm a bit nervous about the business side and towards foreign business as well, that they just say, you know what, this Labour government seems to do things in a way that we cannot truly be sure what they say is what they mean. And so I'm getting a bit nervous, and the Bank of England should be nervous about that, as you rightly say. So I have a hunch, or I would suggest the Bank of England might suddenly cut more than the market has priced, exactly for that reason.
Yeah.
To get ahead of the curve.
No, well, thank you for that. Obviously we'll cover that in more detail nearer the time. But no, Beat, thank you very much for your wise words today and your insights.
Thanks for having me, Harry.
No, it's a pleasure. And we'll be doing another one. We'll have guests on for the ECB next week, and we'd love to have you back on the show again at a later date when we cover more subject. But listen, thank you very much. I'm just going to quickly go back over the numbers for those Live Squawk members. Just plug in and listen in at the bottom of the hour for the jobs report. For those who don't know, livesquawk.com. Try us out, see what you think. News, a real-time news service that gives you all the pertinent news as and when it happens. Right, just to quickly go over the numbers again, then we've got non-farm payrolls for August expected at 165,000 for 114,000 last month. Private payroll seen at 140,000, also rebounding from July as 97,000 print. Manufacturing seen down 2,000 after a gain of 1,000. The unemployment rate seen to fall to 4.2% from 4.3%. Average hourly earnings pegged at 0.3 from 0.2. On the year-over-year number, that was month-over-month. Year-over-year seen at 3.7 from 3.6. Labour force participation expected to remain on hold at 62.7%. Underemployment rate came in at July at 7.8. Bear in mind, as I said, Beat's words on where we're at today. Also note that this is going to be I think it's going to be a volatile number unless we're bang on the button. Then you look at the breakdown of the unemployment rate and average earnings. But ultimately, this number it should produce some volatility and should produce some momentum for the markets. I think going into the last day of the week, stateside at least anyway, and for the rest of the European session. So be careful trading it if you are going to trade it. I'll just give you one more note from one of the bank. You got SocGen anticipates a rebound in non-farm payrolls following the soft reading in July. They say the below-trend July gain was influenced by a few services industries, including information services, business services, and private education. These factors, which are not expected to be weather-related, have raised questions following the July employment release. Without repeated losses in these categories, non-farm job gains are projected to approach, in their mind, 150,000. Trend increases could result in a non-farm increase of 170 jobs, and an offset to earlier weakness could lead to larger gains. Just bear in mind that there is a range on today that, again, we have a range anyway, but on our chart that you have a look, Citigroup have gone for 125,000. TD Securities at the other end of the scale have gone for 205,000. So it's quite a wide range based on last month's factors, and whether we'll see them repeated, or as many predict, we should see better numbers for today. So yes, with that in mind, we'll be back on Thursday for ECB. We'll produce a preview show for that, so please come back for that, and have a good Friday, have a great weekend, and thank you for listening. Thanks for tuning into the Live Sport podcast. Your edge in the market starts here. Subscribe now.